Hey, JJ here with the Art of Value. This is episode 101, Investing 101. Okay, so embarking on the next 100 episodes. Today I'm going to talk about, I hope you can't hear that motorbike going past here. I'm in the car, soundproof booth at the moment. It's the best place to record at the moment in the current situation that I'm in. And so I want to talk about this interview with Stanley Druckenmiller. Stanley Druckenmiller, the Druck, sometimes called the Druck. And this was an interview from about 3 weeks ago, I think, at the SOHN conference. I think that's what you call it, SOHN. And it was a good interview. And the interview was by John Collison, who is, if you don't know, one of the co-founders of Stripe. So it's interesting, really kind of young entrepreneur interviewing a veteran investor, and he's known as a macro investor, makes big macro calls, pretty focused, and is more of a trader than anything else. He was trained, educated, worked for George Soros for quite a long time, and so I think we can think of him in that vein. So the interview is pretty long. It's 1 hour 10, so I'm just going to summarize it and give some comments along the way. Hopefully it'll be shorter than 1 hour and 10 minutes. But some of the points that he makes are inflation being 5%, the market as an economic predictor, crypto effect on other asset classes. He talks about gold versus Bitcoin, talks about the conviction and being hot and cold as a trader, being either hot or cold, he believes in streaks, like not lucky streaks, but being on like a baseball streak, for instance. And his advice to young investors. He talks about that period in the market where COVID beneficiaries really took off. He talks about his bias towards growth stocks and taking account of that, thinking about that. And he talks about the market's pain scale, so the possible scenarios going forward. He does give some market predictions, and he's pretty pessimistic on the macro situation because he talks about being bullish, the bullish and bearish possibilities. So Stan is one. Also, John talks about Stan being a role model for a lot of young investors because of his top performance, well-deserved top performance over many decades. He watches the macro, and he's a macro investor. So I just want to say to the outset, I think it's a bit pointless, and Stan mentions this. It's a bit pointless looking at his 13F filings for the last quarter because he can be in and out pretty quickly. If he changes his mind, he could just give an interview one day and then change his mind the next day. It's just like that. So it's not worth kind of looking at what he's in now. But he did have energy, quite a bit of energy stocks, I think, at this time of the interview. So he said John starts off saying last summer when the market was hunky dory, nice phrase, quaint phrase, hunky dory. John's Irish, and said the monetary and fiscal policy is out of step with economic circumstances, and he saw a raging mania in all assets. So he was basically calling a massive bubble last summer, Northern Hemisphere summer. And what is he predicting now? Which is pretty much what we want to know, right? So Stan says, I've had many predictions that didn't turn out. So it's nice that you picked one that did turn out, he says. Being fairly modest there, but selective picking. He's been right more than he hasn't been, or as he explains, when you're right, you've got to when you're right and you think the odds are in your favor, sort of bet big. Selective picking, he said, and inflation is a little higher than I thought it would be, but I did think it was going to be above 6%. Obviously, it's about 8% right now, which seemed radical at the time, a radical call at the time. So that's what he was calling. That was correct. He said, the bubble has really burst with a vengeance, a lot more than you can see in the S&P 500. This was probably a month ago, I'd say. A lot of good companies have been derated 60-70% without a whole lot of change in the fundamentals. So valuations have improved relative to where they were. And the Fed was slow to recognize the problem that we have, and they were still buying bonds in March 2022 and not pivoting verbally until November. That period was incredibly costly, he says, for the market I think he's talking about, and the macro environment. A lot of assets were bought in that period that people will lose a lot on. The people were kind of, because the Fed wasn't sort of not raising alarm bells, but not pivoting to their new stance. Inflation was transitory until it wasn't. Where are we now? John asked, and he said, it's hard to believe we can unwind in 6 months, but best guess is that in 6 months, we're 6 months into a bear market that may have some time to run. Highly probable that the bear market has a ways to run yet, he reiterated. Is it going to be a soft or hard landing? Another burning question that people talk about. Is it going to have a recession or not? I don't know, but the probabilities of a soft landing are pretty remote, he said. So he kind of does have conviction on that. And his reasoning, we've only pulled off 2 or 3 soft landings in history, like in 1994 and 95, which he invested through, and never had a soft landing without when inflation got to above 4.5%. So that's a historical fact that he's pulled up. We never had a soft landing when inflation got to above 4.5%. It's like 8.5% at the moment. We're facing an extraordinary situation. Projections of 2% rates. We're so far behind the inflation rate. We are so far behind the inflation rate. And such a good asset. It's such a broad asset bubble going into it, he said. It's very hard to say we'll have a soft landing. The indicators aggressively point to a hard landing. I've been wrong plenty of times, he said, but betting on a soft landing to me is a long shot this time. And history says when inflation gets above 5%, it's hard to tame it, and it's never come down until the Fed funds rate has gone above CPI, which is currently above 8%. So that would imply that that interest rates could go over 8% if inflation stays that high, even if this is me talking, even if it goes down to 5%, it means that the rates would go over 5%. He says it's been a disruptive period, and for like in tech, and he gives the example of Stripe because John's there, but there should have been many bankruptcies during that period, but they were saved by the Fed. So the destruction would be quite material if rates go up that much. So he's hedging his position, not hedging his position. They said if inflation rates do go up, all bets are off because it'll be a very hard landing. I think he's implying there. I do think inflation is going to come down without that happening, though. He says, I think a recession is in the cards. I just don't know when. I'm guessing sometime in 2023. So he's not guessing that we're in a recession now, or that which is quite possible. I think that we'll see. So Stan thinks the stock market is an indicator of the economy. That's how he looks at things, that the stock market indicates the economy, not the other way around. So a lot of people have the opposite view, that the stock market isn't the economy. Well, he's not saying it is either, but it's an indicator of what's happening in the economy long before, say, the Fed, most economists look at. He looks at different indicators, and he looks at the market. So he says stocks tend to, this is really important actually for his philosophy, and it's really interesting. He says stocks tend to lead the fundamentals by 6 to 12 months. So stocks lead the fundamentals, but there is also a market inefficiency. He indicates indicators are industries that lead the economy and ones that lag, like housing and retail. Leading industries that indicate what's going on in the economy, that is, housing and retail, for instance. We do the macro by listening to companies that lead the economy and ones that lag. Bottom-up analysis from there. If the leading industries are turning up or down, that's a signal. It has worked beautifully. Another signal is the bond market, but not in recent years because it's been manipulated by the Fed. and the approach has allowed us to outperform the Fed in terms of economic forecasts over the last 20 to 30 years. So he thinks the way that they do macro forecasting has outperformed what the Fed's been thought. And he also says that sectors have been he was asked what sectors have you been looking at as indicated as predictors, and he says not getting fancy, you just have to look at the home builders themselves right now, which supposedly with supposedly good fundamentals, they've all declined 50% from their market highs. Also trucking down 40% since reporting record, and despite recording record earnings. And retail, he said, to a lesser extent, it's a little tainted because of COVID, but even so appears to be weaker than it should be compared to GDP numbers. All this is a signal that there may be trouble ahead. It can be 6 months to a year before it's seen in the wider economy. And he's made higher returns in bear markets than in bull markets, he says, but you have to innovate and not be a slave to past models that you've used. Bonds have been a go-to in bear markets, but not this time, he thinks. He says currently, in terms of forecasting and analysis, he says on the macro, he says currently I'm very challenged. We've been lucky to make some money in the past 6 to 8 months. But by being short fixed income and short stocks, not doing much in currencies, and owning some key commodities like oil, gold, which he said hasn't worked, and copper. He said it's getting harder now, though, to make money in this bear market. Not so confident being short equities, he says. Taking a bit of a break from that and waiting for a fat pitch. That's Buffett saying you don't have to hit or swing all the time. Wait for the big fat pitch and then swing big. Pretty much is his similar philosophy. And fixed income has been complicated. He's sitting on the sidelines for that. And currencies, he's not doing much, but might short the dollar at some stage. He still owns energy, and Ukraine he says has extended that trade, and he thinks it could go on for some while. But he said don't quote him on that. He could change his mind tomorrow. That's the way he rolls. Depending on what he sees out there. But he's saying there's no demand collapse or anything at the moment. How would you get to higher conviction on shorting in the current environment? He says shorting stock, because he's not shorting much. If the market were to rally 15 to 20% over the intermediate term, he said, I'd take a shot, because 6 month bear market preceded by asset bubbles don't exist historically. Let's say that again. 6 month bear markets preceded by asset bubbles don't exist historically. And I think we still have a lot of wood to chop, meaning still more to go down. On interest rates, I want to hear where the Fed is to see how that's unfolding, and then see on inflation if it's embedded or not. There's a lot of people saying that it's still going to go down and it's not embedded. This is just still basically temporary or transitory, but longer, but still transitory. I'm taking a break, he said. I want to be fresh, and I'm in no hurry. It's a marathon, and I'm not running flat out on mile 16. And keeping in mind, if you don't know, that a marathon's 26.2 miles, I think. And so that's on the macro situation. He was asked about crypto, which was also interesting. He said he expects it to affect other asset classes, the decline in crypto, and strong correlation between crypto and the NASDAQ. That seems pretty obvious now, even though a lot of people say it's not supposed to be. It's sort of independent, but it's pretty much moving like the NASDAQ since it started declining. He's sympathetic to Munger's view on crypto and to Bill Miller's. So if you don't know, Munger's very down on crypto, thinks it's all going to go to zero, and thinks it's all a Ponzi scheme. And Bill Miller's pretty heavily into it. He's just going with the flow and buying And so he sort of understands that. He said it's yet to play out, and I don't want to bet on it with any conviction either way. He'll be surprised if blockchain isn't a force in the economy in 5 to 10 years from now, a major disruptor with some companies, he said. Keeping in mind he's talking to the Stripe founder, a disruptive company in the fintech space, one of the biggest, and not a public company yet. So he says he's 69, but a younger Stan would be diving into it much more. Younger people understand new asset classes much better, or classes better than he would. He understands that, and sometimes he's employed younger people and kind of directed them in terms of how big their trades are. He talks about that in the .com bubble. He did that even back 20 years ago. He said, if I were a tech investor, I'd certainly be looking into blockchain very deeply and the possible disruption it might take. But fundamentals are fundamentals, he also says. So that's interesting. If he was younger, he'd be getting into blockchain as a disruptor of the future of the next 5 to 10 years and more. Now he's asked about gold versus Bitcoin. He said if you had an irresponsible monetary policy going on, which he thinks there is, in a bull case you might want to own Bitcoin, and in a bear phase you might want to own gold. He said if there's an inflationary bull market, I'd want to own Bitcoin more than gold. And he says if there's a bear market, a stagflation type of bear market, I would want to own gold. Oh, he said, actually, sorry, did I say inflationary bull market? He would want to own Bitcoin more than gold, and a stagflation bear market, he'd want to own gold. But you've got to know, or you also got to know where your biases are. This is, take for the listener, think about what his biases are. Where he's older and he's got a growth investor bias, growth company bias. I'm a hard worker, but I'm just stimulated by the game of thinking about how the world will look in 6 months. He said, he said it's like he works hard, but only because it's fun. He loves the game, which a lot of great investors say. They just love the game of probabilities. I do fear for the retail bull market geniuses, he said. There's a lot of them who were surfing with a hurricane behind them, and there were nice waves behind them. So this is talking about the last few years. They may become very discouraged if the story does not end well. Well, it hasn't ended well, but he thinks if it gets a lot worse, people could get very discouraged. So here's the philosophy of putting all eggs in one basket and then watching that basket carefully. So it's contrary to what is taught in a lot of business schools, but he doesn't want stale longs or stale shorts. They both trouble. Better to be concentrated and paranoid. Sizing is 70 to 80% of the equation. This is something that George Soros taught him. It's how much you're right or wrong. And it's not how much you're right or wrong. It's how much you make when you're right and how much you lose when you're wrong. And he learned that from Soros. I also believe in streaks. Sometimes you're seeing the ball, sometimes you're not, like baseball. Now, know when you're hot and when you're cold. Turn up the dial when you're hot, and when you're cold, don't make big bets to get back to even. Be self-aware. He'll size up positions of technical analysts that work for him on his team who are on a hot streak. So he's learned to tell who's on a hot streak and who's not. So this is pretty different from like value investing Buffett, where it's very long term, and it's not like this is really trading stuff. And this is in the past 10 to 20 years, you don't have the time anymore to do deep dive analysis. That's different again, but wait, he says you do have time, but if you have the intuition, you buy it and then do the analysis after that. And if it doesn't pan out, as opposed to wait to do the analysis. So you don't do the analysis first and then buy. You can buy some and then do the analysis like over 10 days. That way, when you enter it, he says there's no story out there. And in 10 days, there's probably still no story if you're wrong. And there's a bear market story. If there's a bear market story, you'll find out in the meantime. He talked about analysts going out to dinner and talking, so you'll find out a bear case pretty quickly. And then he talks about the famous story of the tech bubble where he lost billions, but it's more complicated than that. He talked about he put this is how it played out. He put long trades on in the last days, even though he knew it was dangerous. And how he came to that was the longer version of the story is that in March 1999 he shorted internet stocks to the tune of $200 million, and it was a $600 million loss. And so he was down double digits after that for the year, and he backed off. And he hired two people in their 20s who were keen on internet stocks, knew more than he did. He pivoted to internet stocks and was up 42% for that, and so he had a massive year. But in January 2000, I'd say it's a bubble to Soros, and I sell them. So in January 2000, he pretty much sold exactly at the right time. But his two young guns who were working for him were making like 8% a day. And so this started to get at him, drove him nuts. And he says now it's March 2000, which is pretty much, that's when early March 2000 is when the bubble started bursting. He says, I have a devil on one shoulder and an angel on the other. And I bought and missed the top by about an hour, he said. And I bought $6 billion. It was huge. It was a massive loss, $2 to $3 billion. The exit was messy, and I was down 18% again. Wow, 18% from up being that much. And I was emotional. That's not too much when you think about it. He says I was an emotional mess, and said I was quitting, exhausted. It took a while to get out of the trade. And he went to Africa on holiday. Didn't look at the markets. Took a true break, not knowing what was going on. And then the market. And when he got back, the market had recovered quite a lot. It's sort of what you call a dead gorilla bounce, perhaps. And so he had a clear head. He had got confidence back somehow, and he said he put 350% 10-year equivalent of the fund in treasuries, betting that Greenspan would tighten and we'd go into recession, which played out. It was 40%. He made 40% in the fourth quarter, even though he'd given up for the year. He needed a break, and if he hadn't had a break, he wouldn't have done it. So he advocates having a break when you kind of get into that position, and he cleared my head, and I could see the trade and scale it to restore confidence. He said Soros made him focus on what moves the stock price. That's, I guess, we're talking about catalysts. Made him focus on that. What moves the stock price, not and change. So change moves stock prices, not the now. So during COVID, people invested in the moment. A look at new retail investors came in. They were rewarded immediately in the early parts of COVID, but they'd never played the longer game. More new money in the market exaggerated the effects of COVID beneficiaries. He had a bias towards. He says he has a bias towards growth stocks and ignored that over the past year or two because he saw the bubble there. He says he does a lot of counter-cyclical trades, but his biggest money has actually been made in growth stocks over time. So he forced himself just to back off in that during that COVID period where all the emerging techs went nuts. John asked if is big tech getting too cheap to be not in on it. He said, not yet. I'm too bearish on the world, and too cheap. It's cheap, but it's too cheap to have shorts on though. Michael Burry has puts on Apple. I see. Don't know if he still does. That was the last 13F. Ocean shipping and trucking are over earning, he said, and the world might look quite different. It might pull back, and it's much harder to short now. Talks about energy trades. They've got caution against. He says he cautions against looking at his 13Fs because he moves quite fast, and it's not the thesis it was a while ago. So implying that he might not be in traditional energy anymore. But he said it's still cheap, and he does see could see it 2 to 3 years out being, a sustained trade basically. He can't see demand destruction. He's not seeing it yet. This was a month ago, mind you. But it's gone down a bit. Back in 2005 was a warning of financial crisis coming. He he was out of, John asked, you were 9 out of 10, bearish back then, and how about now? And there's no historical analog for the economic state now, he says. He's open-minded to something really bad happening. This guy on one shoulder, and he's not predicting it, but not sure. And on the other shoulder, he says he's open-minded because this is hard to analyze the situation as ever before. It's harder than ever in his career to analyze what's going on now, and we have not seen this before. 2005 was a no-brainer, he thought, by looking at housing charts, all this securitizing of financial products. He was shorting housing. He was wrong for 6 months there, but it did play out, which is a common story with Michael Burry, was long for a while there too. He was wrong for a while there too early, but it happened. So he can see a possible grim scenario like the 1930s, absolutely buying power destruction, and then the Fed pumps it all up again, and we get horrible stagflation, or do we get deflation? So could be inflation or deflation. Kathy Woods is calling deflation, and Michael Burry is calling massive inflation. So take your pick. Every deflation has followed. He didn't say that. I said that. Every deflation has followed an asset bubble. He said the Fed has created the biggest asset bubble and the broadest in history. A lot of air has already come out, but it's so big, I have to be open-minded about the consequences. So he's basically saying there's air come out, but it could be bigger. It could be no growth and sideways for 20 years of it. But macro, and then he was asked why he was a macro investor. And he says macro investors like chaos and outperform. You outperform in a bear market. He has been, but his bias is actually, he has a bearish bias, and we need to be aware of that and all the pessimism. And they have plenty of options in a bull market too. So in 1995 and to 1990 did well, for instance, and he has a growth investing bias. All right, that's pretty much the summary of the interview. Really interesting. I found it fascinating because he's been one of the most successful macro investors and made probably more right calls than wrong, although he could be wrong. Just fascinating what he's been through, decades of it. So really interesting to see what Druck has to say when he does speak about what's going on compared to last year, which he was pretty much right about this bubble bursting. All right, that's it. So if you got any value out of this, like and subscribe, follow wherever you can on your favorite apps and sites, YouTube, Spotify, Apple, and join me on Twitter at The Art of Value. Okay, see you next time.